welcome to the deep dive.
Great to be here.
Today, we are tackling a number you see, well, everywhere in finance, but how it's calculated. That can often be a bit of a mystery, kind of hiding in plain sight. We're diving deep into earnings per share, EPS, and we're guided by some key accounting guidance on this, specifically the stuff updated back in November 2021.
Yeah, ETS, it sounds so straightforward, doesn't it? Earnings divided by shares. Easy.
Right.
But, look just below the surface and you find all these layers of accounting rules. They're really designed to make sure that per share number actually means something and that you can compare it between companies.
Okay, so let's unpack this then. Our mission today. Pull out the really critical insights from this guidance. We want you to walk away understanding what actually shapes that EPS number you see. Like, why are there often two different EPS numbers, basic and diluted? How do complex things like stock options or convertible bonds fit into the picture? And, what's changed recently?
Exactly. We'll hit the core idea of EPS. Who actually has to report it? It's not everyone. Then the big one, the difference between basic and diluted EPS. And we'll explore the main ways companies figure out how all those potential future shares impact the calculation today.
Sounds good. So let's jump right in. What is earnings per share, fundamentally? Why is this number such a big deal?
Well, at its absolute core, EPS translates a company's overall performance, its profit, into a single share unit. It's a required reporting item for many companies, and the guidance is all about making sure everyone calculates it, presents it, and discloses the details consistently.
And for our listener, maybe they're an investor, an analyst, or just, curious, why should they zero in on EPS?
Because it gives you a direct per-share slice of the company's profitability. Think about it. Total net income can be massive, billions maybe, but it's hard to compare a giant company's total profit to a smaller one's.
Right, scale matters.
Exactly. EPS gives you a standardized metric, so you can actually compare different companies or just track one company's performance over time, even if its number of shares changes. It makes profitability much more relatable to the single share you might own or be thinking about owning.
Got it. Puts profit into perspective. Is every company required to report EPS?
Not quite every single one. The rules are pretty specific. It's mandatory for any company with publicly traded common stock, or, and this is important, securities that could become common stock things like options or warrants.
Okay.
And it's also required for companies filing paperwork with regulators like the SEC to sell shares to the public. Think IPOs.
Right, companies going public.
Yeah. Now, private companies, they can choose to report EPS if they want, but they don't have to.
Okay, so if you're looking at a public company's report, you will see an EPS number. Let's start with the first type mentioned, basic EPS. This feels like the foundational number.
It absolutely is. Basic EPS is the starting point. It shows the earnings available to the current common shareholders based on the shares that were actually out there outstanding during the period. The calculation itself sounds simple. Income available to common stockholders divided by the weighted average number of common shares outstanding.
Okay, let's break that down. The top number, the numerator, income available. My first thought is, isn't that just net income? But the guidance says it's not always quite that simple.
Right. You usually start with net income, yeah. But then you have to make adjustments to figure out the amount that's truly available only to the common shareholders.
Okay, likewise.
The main one is preferred stock dividends. If a company has preferred stock, especially the cumulative kind,
Where dividends pile up if missed.
exactly, you have to subtract those preferred dividends from net income to get to the income for common shareholders. And this is key. You subtract them even if the company hasn't actually declared or paid them in that period.
Oh, interesting. Why?
Because those earnings effectively belong to the preferred holders first. They're not really available to the common stockholders until those preferred claims are covered. So they come out of the pot before common gets its share.
Okay, that makes sense. The source also mentioned something called participating securities. How do they affect this income number?
Participating securities. These are interesting. They're not common stock, but they have rights to share in the company's earnings beyond just a fixed dividend. They participate with common stock in the leftover earnings.
How does that work?
Well, it might be tied to certain events, or it could just be part of how security is structured. Because of them, you often have to use something called the two-class method.
Two-class method. Okay, what's that?
It's basically a way to allocate the earnings that aren't paid out as dividends. You take the income after any declared dividends for both common and preferred, and then you figure out how to split the rest, the undistributed earnings, between the common shareholders and these participating security holders.
Based on their specific rights.
Exactly, based on their rights to those earnings. The goal is just to make sure the income number used for basic EPS, that numerator accurately reflects what's left just for the common shares after accounting for everyone else who gets a slice of the earnings pie.
Okay.
And it's worth noting, if the company actually has a loss for the period, that loss is usually allocated entirely to the common stock. Participating securities typically don't share in the losses unless the contract specifically says they do.
Got it. So the numerator is income available, net income adjusted, potentially significantly. What about the bottom number, the denominator, the weighted average number of common shares?
Right, the denominator. That's also not just a simple snapshot count of shares at the end of the quarter or year. It has to be a weighted average.
Weighted how?
It reflects the number of shares outstanding for the actual portion of the reporting period they were outstanding. So if a company issues 1 million new shares exactly halfway through the year, those shares only count as 500,000 shares in the weighted average for the full year.
Because they weren't there contributing to earnings for the whole time.
Precisely. It gives you a much more accurate base for comparison period over period.
And this is where we see a really key distinction, right? Things like stock options, warrants, even convertible debt, they don't usually impact this basic EPS number.
That's exactly right. Even though they could become common stock down the line, for basic EPS, you're looking at the world as it is now with the shares currently outstanding.
Which perfectly sets up the next part of the conversation. Diluted EPS.
The what-if scenario.
Let's go there. Diluted EPS. You said what if. What does that mean? This is where it gets really interesting, I think.
It definitely does. Diluted EPS is designed to show the maximum potential dilution of earnings per share. It tries to answer the question, what would EPS look like if all those potential common shares out there, the ones that could dilute earnings, were actually issued?
So potential common stock, that's just anything that could turn into common stock eventually.
Pretty much, yeah. The guidance defines it as, any security or contract that might give the holder the right to get common stock. Think stock options, warrants, convertible bonds, convertible preferred stock, even shares that are promised only if the company hits certain targets, like in an acquisition earnout.
And the point is to show investors the sort of worst-case scenario for dilution.
Essentially, yes. It's meant to be a conservative measure. Diluted EPS only includes these potential shares if adding them would actually decrease the basic EPS number. Or, if there's a loss, increase the loss per share.
So if converting something would actually increase EPS, you can ignore it.
Correct. That's called anti-dilutive, and those securities are excluded from the diluted calculation because including them wouldn't show the maximum potential dilution.
Okay. Now, the guidance highlights two main ways companies figure out the impact of these potential shares for diluted EPS. Let's start with the treasury stock method.
Right, the treasury stock method. This is the one you typically use for things like stock options, warrants, stock appreciation rights, restricted stock awards that haven't vested yet, and sometimes employee stock purchase plans, ESPPs.
And the core idea here is kind of fascinating. It assumes if people exercise their options, the company takes the cash it gets and uses it to buy back its own shares.
That's the central assumption, exactly. You pretend the option or warrant was exercised, usually assumed at the beginning of the period or when it was issued if later. You calculate the cash proceeds the company would hypothetically receive from that exercise.
Okay.
Then you assume the company uses that cash to buy back its own shares from the market, but crucially, at the average market price during that period.
And only the extra shares, the difference between shares issued and shares bought back, get added to the denominator for diluted EPS.
That's the key. If the average market price is higher than the exercise price of the option or warrant, meaning it's in the money.
Which is when someone would actually exercise it.
Right. Then the cash proceeds from the exercise won't be enough to buy back all the shares that were just issued. The shares you issued minus the fewer shares you could repurchase. That difference, those are the incremental shares added to the denominator. They're the ones that cause the dilution.
So the dilution impact depends directly on how much the stock price is above the exercise price.
Exactly. The higher the average stock price, the more dilutive those options and warrants become under this method.
And you mentioned this also applies to things like restricted stock or ESPPs, but the proceeds might be calculated a bit differently.
Yes, the underlying concept, assumed issuance and repurchase, is the same. But for, say, restricted stock, part of the assumed proceeds might actually be the unrecognized compensation cost associated with the award. For ESPPs, it might involve assumptions about employee contributions. The guidance gets into those specifics.
Okay. And there's also a reverse treasury stock method mentioned briefly.
Yeah, that's for certain contracts where the company might be obligated to buy back shares, like some put options or forward purchase contracts. The assumption flips. You assume the company sells shares at the average market price to get the cash needed to satisfy that obligation.
Okay, so that covers the treasury stock method, mainly for option-like instruments. What's the other main method? The if-converted method.
Right. The if-converted method is used for convertible securities. So think convertible debt or convertible preferred stock.
And the assumption here is totally different. You just assume the security was converted into common stock right at the beginning of the period.
Exactly. Or if it was issued during the period, you assume it was converted on the date it was issued. You're calculating EPS as if that conversion had already happened for the whole time it was possible.
How does that affect the calculation? Both the numerator and denominator must change, right?
They do. For the numerator, the income part, you have to add back certain costs that wouldn't have existed if the conversion had happened. Well, for convertible debt, you add back the after-tax interest expense associated with that debt, because if the debt had been converted to stock, the company wouldn't be paying that interest, right?
Makes sense.
And for convertible preferred stock, you add back the preferred dividends related to that specific stock, because again, if it was converted to common, those preferred dividends wouldn't be paid.
Okay, so you adjust the income upwards. What about the denominator, the shares?
That one's more straightforward. You simply add the number of common shares that would be issued if the conversion actually happened.
And this if-converted method area is where some recent accounting updates, ASU 2020-06, made some pretty big changes.
Yes, that update was significant. It really simplified the accounting for certain types of convertible instruments, especially some complex convertible debt structures like those with cash conversion features. It often means they're now treated more consistently under this if-converted method for EPS.
So the insight there is it's easier now for investors too.
Pretty much. It removed some of the prior complexities, especially around how settlement features affected the calculation. So it generally makes modeling and forecasting the potential EPS impact of these specific instruments a bit more straightforward for analysts and investors.
Okay, so we have treasury stock, and if converted is the main methods. Are there other potential shares we need to think about for diluted EPS?
Yeah, a couple of others worth mentioning. Contingently issuable shares.
Like the earnouts you mentioned earlier.
Yeah, exactly. Shares that will only be issued if certain conditions are met, maybe hitting a profit target after an acquisition. For diluted EPS, you include these shares in the calculation if the conditions have actually been met by the end of the reporting period, as if they were issued then.
Okay.
And then there are various other arrangements, maybe things that could be settled in cash or shares. The guidance has rules for those too, and how they're treated often depends on the company's stated policy, their past practices, or their ability to actually settle in shares.
Wow, okay. So it's clear the company's whole capital structure, the mix of debt, preferred stock, common stock, options, is a massive factor in all these calculations.
Absolutely.
How are really major changes handled? Like, what if a company does a stock split, say 2-for-1, or issues a stock dividend?
Those are treated differently because they fundamentally change the per share unit itself. If a company does a stock split or a stock dividend, they have to go back and retroactively adjust the share count used in the EPS calculation for all the prior periods they present in their financial statements.
So all the historical EPS numbers change?
Yeah. You restate them as if the split or dividend had happened right at the very beginning. This is critical so that the EPS trend you see over time is actually comparable on an apples-to-apples basis. Otherwise, a split would make EPS suddenly drop, which isn't reflective of performance.
That makes total sense. The source also touched on pro forma EPS, especially with some updates in May 2022. When do we usually see pro forma EPS?
Pro forma EPS usually pops up when a company is going through or about to go through a really significant event that will change its capital structure. The classic example is an initial public offering, an IPO, or maybe a huge recapitalization.
And why is pro forma needed then? What does it show?
It provides a hypothetical look, a what-if scenario again, but a different kind. It shows what EPS would have been if that major event had already occurred much earlier.
For example?
Okay, say a company going public plans to use the money raised in the IPO to pay off a big chunk of debt. Or maybe all its existing preferred stock will automatically convert into common stock as soon as the IPO happens. Pro forma EPS calculates earnings as if that debt payoff or that preferred stock conversion happened right at the beginning of the earliest year shown in the IPO documents.
So it gives potential new investors a sense of what the company's profitability per share looks like under the new post-IPO structure.
Precisely. It's required by the SEC in certain filings like IPO prospectuses because it gives crucial context about the company's financial picture going forward, based on the structure it will have after the big event.
Okay, we've covered a lot on how it's calculated. What does a company actually have to disclose about all this in its financial statement footnotes?
Well, the accounting standards, ASC 260, require some key disclosures to help users like you understand the numbers. Probably the most important is a reconciliation.
Reconciliations.
Yeah, showing the math. It's a table that starts with the numerator and denominator used for basic EPS, shows the adjustments made for dilutive securities, like adding back interest for convertibles or adding the incremental shares from options, and arrives at the numerator and denominator used for diluted EPS.
So you can see exactly what caused the difference between basic and diluted.
Exactly. They also need to describe the main types of potentially dilutive securities they have outstanding. So the footnotes are really your roadmap to understanding why diluted EPS is different from basic and what the specific sources of potential future dilution actually are.
Okay. So after wading through all these rules, methods, adjustments, what's the big takeaway for someone reading a financial report?
I think the main thing is realizing that while EPS often gets presented as just one or two simple numbers, it's actually the result of a very structured, sometimes quite complex calculation. It's influenced by a lot more than just the headline net income number and the shares people currently own.
And really understanding that difference between basic and diluted EPS, that's not just for accountants, right? It gives real insight.
Absolutely critical insight. Basic EPS tells you the reality now. Diluted EPS gives you that crucial look into the potential future state, assuming maximum dilution happens. If you only look at basic EPS, you might be missing a really significant part of the story, the potential impact of outstanding options, warrants, or convertible securities on future per share value.
Diluted EPS gives you a lens on that potential future drag or expansion of the share count.
Precisely. A vital lens.
So we've taken quite the deep dive into the world of earnings per share today. We've peeled back the layers from that foundational basic EPS calculation all the way through the complexities of diluted EPS, the methods used, and how things like stock splits and IPOs affect the numbers.
Yeah, hopefully this gives everyone a better appreciation for the detail behind this number you see quoted everywhere, and maybe it makes you a more informed reader of those financial statements, looking beyond just the headline figure.
Absolutely. And maybe here's a final provocative thought to leave with everyone. Think about the gap between a company's basic and diluted EPS. That gap is a direct measure of how much potential common stock is hanging out there. So what might a really wide gap between basic and diluted EPS implicitly tell you? Maybe about management's past decisions on using stock options for compensation. Or maybe about their financing strategy, using lots of convertible debt. And how might watching that gap change over time give you clues about the company's future capital structure, potential dilution risk, or even future value? Something to chew on next time you glance at an earnings report.
Definitely something to think about.
Thanks for joining us for this deep dive.